Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Markets show resiliency, but the next phase may be far less straightforward. Geopolitics, energy shocks, and inflation are starting to pull in different directions, and our next guest says we're in for an uneasy equilibrium, and the next few weeks could be critical. So what matters most for investors at this next phase as it unfolds? Joining us here today to examine the trends and the themes driving both global equity markets and bond markets is Ayesha Akbar. She is portfolio manager of Fidelity Global Asset Allocation Fund. She's joining us from London. Lovely to see you. How are you today?
I'm very well, thank you, Pamela. Always a pleasure to be here with you.
Delighted to have time to speak with you here today. And we've been all watching markets. You've been watching them probably far more closely than just about anyone else in terms of the allocation story and what you're doing. I wonder if you'd take us back, Ayesha, to the beginning of the year and sort of to get to the point of how much change you've made. But why don't you begin with sort of January 2026 and how you entered the year?
Great place to start, and it's amazing to think how much has happened in the last few months. So we started off the year pretty positive on markets, and that was really because the growth story looked pretty good. What we were worried about really was about inflation perhaps not being as low as everyone was anticipating, and that was really because we worried a little bit that the AI story that had been powering markets wasn't going to be as productivity enhancing as perhaps markets were hoping for. So that kind of meant that that great growth story, the U.S. doing fantastically well, rest of the world not doing too badly either. Emerging markets actually doing pretty well. That growth story was pretty good. Inflation, yeah, maybe a little bit of a problem. And from a top level perspective, that kind of meant that we were positive risk assets. They tend to do better when growth is strong. Which meant we were overweight equities, and we didn't particularly care that much for bonds and didn't want to hold cash in this environment. And that worked really well for January and February, right? In fact, perhaps a little bit too well. Markets really did start off on a pretty big tear. And I guess you have to be careful about what you wish for, because obviously we all know what happened at the end of February and March. And that really was a little bit of a shock to the system. So, obviously events in the Middle East had a pretty immediate effect on oil prices. And the view that we took initially was this was far more likely to be a supply side inflation shock rather than necessarily a growth problem. And what that meant was that actually the way we were positioned wasn't too bad at all, because it was going to hurt inflation bonds in particular a little bit more than perhaps the growth story. And that's kind of where we stayed. And one of the reasons we didn't make too many changes, since it's the start of the conflict, was really because markets have been incredibly volatile. So what we didn't want to do was sort of make too many changes and just be on the wrong side of particular dates. Now, the good news, of course, in terms of what we've seen happen so far is that we have come to a sort of ceasefire event. You called it an uneasy equilibrium, and I think that is a pretty good way of really kind of characterizing it, because it isn't really in anyone's interest that things escalate from here. From the American side, obviously keeping the straits open is quite important. You don't necessarily want the rest of the world plunging into recession. And from an Iranian perspective, given that they're making a little bit more money than they have from their oil exports, really sort of escalating things, making things worse, making it more difficult for them to get their oil out isn't necessarily in their interests as well. So, uneasy equilibrium. Why is it uneasy? Because, there's too many different moving parts, people with different interests. So a little bit of escalation could potentially have quite problematic effects. But the issue really, sorry, go ahead.
Well, I was just going to say, and actually you're probably getting to it, but at this point, there's been a discussion of, markets can be resilient. We sort of opened saying that, and I'm kind of curious whether that's in the US or if the rest of the world can falter a little bit and the US powers forward. Anyway, you'll get to that, but that is sort of the allocation story, and China being sort of one of the question marks there.
Absolutely. So really two things there. So, one of the reasons we were reasonably confident that not changing our stance too early was the right thing to do, was because if you think about sort of what's been powering, the global economy, clearly the U.S. is pretty important on that side, and really all of the data was indicating that that was going to continue to be the case. So, really some really strong numbers coming out that way. Labor markets generally holding up, although starting to look a little bit sort of on the downside from here. But data generally holding up pretty well. The other thing, of course, remember is what was happening on China. The other main engine of global growth, and China really had been okay. It hadn't been sort of, certainly not as bad as people were expecting earlier. But what has been really interesting since the conflict started is actually how well China has held up. And if anything, the GDP data really does confirm that it did better than before, albeit a lot of that due to the export story that China is exporting to the rest of the world. And of course, that was one of the things that happens when you have global economy in a good place. People want to buy. So both of those engines doing reasonably well, which made us a little bit more confident. The question, of course, is what happens going forward from here.
What happens
US,
specifically outside of the U.S.? Because it's hard. I'm curious if you start to look at the world through those that are energy producing nations or not. This becomes sort of the supply model. Do we have the right ones? Do we start to look at demand destruction ultimately? How do you sort of split it if you do?
Yeah, I mean, I think so for us, it's really been a question of taking down our top level views on markets in terms of perhaps that risk reward between equities and bonds isn't as good as it was initially. At some point that sort of supply shock or inflation shock becomes a demand destruction story as well. So the question really becomes is where is that going to have the biggest amount of impact? Now, clearly, not every part of the world is going to be impacted the same way by what is happening in the Straits. Now, the first impact has been on Asia. Asia is pretty vulnerable in terms of what is happening. And when I say Asia, I mean sort of Asia ex-China, the East Asian economies in particular, big importers of oil, and I think so far it was a little bit better than expected because actually one of the things that we've all learned in the last 5-6 years is how to make supply chains a little bit more resilient. So pretty much day 2 of the conflict, you had people sort of putting in measures that sort of restricted use, made it a bit more efficient working from home, etc. But that can only take you so far. And especially in Asia, it takes about 6 weeks for tankers full of oil from the Straits, which is where most countries get their oil from, to kind of reach where they are. And we're really at that stage and beyond it now. So this is when the crunch really starts to happen. So while it is really good news that the ceasefire is holding, unfortunately, from a market perspective, diplomacy takes a lot longer than the economy can necessarily tolerate. So we really need to start to see a few more ships getting through than we have at the moment in order for Asia to benefit. So Asia clearly at risk. The U.S. on the other side, obviously not as badly affected. Europe is somewhere in the middle. We kind of benefited here in my part of the world that we're coming into sort of summer season, so we don't need necessarily as much gas. Unfortunately for Europe, having reduced the dependency on Russian gas, now we've taken a hit from the hit to facilities in Qatar, which was a pretty big source of gas coming through as well. So not a great scenario from that perspective as well. So first hit to Asia, Europe not looking particularly great, but emerging markets is a different story overall because there's definitely parts of the emerging market complex that benefit from this. So we talked about China being quite resilient and having reserves, but actually LATAM is an area that's doing particularly
That's interesting.
because they are sort of commodity exporters, a little bit more aligned with what's going on in the US, especially now. So really showing quite a lot of resilience. And the other parts that have been doing really well in Asia are places like Korea. That AI story is really continuing and empowering ahead. So at the top level, yes, but lots of stories to play beneath the surface.
Take us a bit further into the LATAM story. This sometimes is discussed within the spheres of influence story. So for instance, the Americas become sort of under the umbrella of the US spheres of influence. I mean, there are problems with this analogy, and it's not all a copacetic thing necessarily, but is that what you see in terms of investment? Because China's had quite a lot of influence in South America over the last decade or so. Will that be crimped at this moment because of an oil blockade, or do you see anything fading there?
So I think, these things always take a little bit of time to play out in terms of geopolitics. And really, our interest from an investment point of view is to see what impact this has on growth and inflation. So the nice thing about what has happened in the US and especially in Latin America, sorry, especially if you look at sort of, what happened earlier in the year, with Venezuela, is that it was relatively quick, relatively aligned. There is likely to be a lot more investment in that part of the world coming from the States. And as one of my very smart colleagues put it, that when you have a corporate takeover, the acquiree sort of the acquirer gets the credit rating of the person who's doing the acquisition. So there's potentially a big benefit to come from being a little bit more closely aligned with the economies of the United States.
Is it safe in that sense? I mean, again, from an investment perspective, is it sort of a safe place to invest? Because you can bet that, for instance, the US isn't perhaps going to consider expanding, or if they are going to expand there, it's going to be sort of a beneficial situation rather than what we're seeing in Iran, for instance.
I don't think we can really say anything at this stage, but what we can say on a relative basis, it definitely looks a little bit better than other parts of the world. In terms of being proximity, is the US really going to sort of create more issues in its own sphere? Probably not. And one of the things perhaps we have learned from Iran is that what would potentially most people, certainly Americans also thought would be a relatively short conflict, can become a lot bigger and drawn out with all the consequences that come with that. So let's not kid ourselves. We know what's going to happen, but certainly on a relative basis, it does look a slightly better environment in that part of the world.
Hello everyone, just a quick break in the show to let you know that Fidelity is giving away branded hoodies. To celebrate over 2 million Canadians choosing Fidelity, you can enter for your chance to win at fidelity.ca/hoodie-contest. Performance is more than a number, so choose performance, choose Fidelity. Now back to the show.
If we go to the discussion of how oil, its trajectory from here, and we do sort of take note of the WTI versus the world benchmark price for Brent, but take us a little bit into the oil story from here and where the demand destruction might initially happen. I mean, China is sort of a big one and a notable one, but I'm just curious if there's more nuance in actually areas that can sustain themselves, maybe through special reserves and so on, that actually look better to invest in. Are there some surprises out there on kind of who is exposed, less exposed to oil?
So I think again, China's the one of the countries that has really come out of this looking pretty good. If you look back at what China had been doing, over the last couple of years, is really every time oil prices dipped, and remember we had oil at about $60 at the start of the year. They had been topping up their reserves. So best guess they have about 6 months of strategic reserves. They have diversified their usage of different energy sources. So definitely being prepared, saving up for a rainy day has paid off. And that's one of the reasons China has been relatively resilient in what has happened. But it's not just about oil, I would say, Pamela, because Brent in particular, since you mentioned it, really has kind of settled in that sort of $100, $105 range for a while, with a bit of volatility around it. But it's not necessarily just about the oil price, because oil is certainly a consideration, but there's a lot of other things that happen in that part of the world that are going to be pretty crucial for what happens in the next 6 months going forward. So one of the more obvious things is how much fertilizer comes out of that part of the world. And if you look at prices for that, urea in particular, prices really haven't come down for that at all. Helium is another one that is quite useful, and quite useful for type stuff as well. So there are going to be implications that we have going forward. Insurance rates have gone up, freight rates have gone up. So it's not just about those things. These are going to have an impact going forward. So that's one of many reasons why I'm a little bit cautious. Markets really do seem to be wanting to go up on every sign that things are de-escalating, and that's certainly a good thing. But even from here, the prospect of things continuing down this road for another few weeks, even, I think there is a real potential that we might start to see shortages. So, I think being a little bit prudent, trying to take a bit of profits on markets as they continue going up, is probably the right thing to do.
So that, as well as, do you see a dispersion story being quite interesting at this moment? Or again, do you just hold on that? I'm curious how you're looking at that.
Yeah, so taking down our top level risk, but really, putting our money into places that really could benefit beneath the surface. So we talked about regions. I think one of the things that we are, starting to add back to is things like, the tech stories, because, in addition to all the other things in terms of, the earnings being quite resilient, that we've seen so far, it's really about, where is the only part of the world that potentially could see rate cuts. This is the other story that perhaps we haven't talked about in terms of there's going to be a new Fed chair coming through, and the chances are that, they will err towards being a little bit dovish. That's not going to happen in Europe. That's not going to happen in many other parts of the world.
Because they've finished the rate cutting cycles in most places. I mean, they're done.
They're done, and any chance of anything more happening because of the inflation shock is just not going to happen. So the only place that potentially could is the U.S. And as long duration assets, tech probably benefits more than other parts of the economy.
So that's sort of the regional and sector story. Is there something beyond tech though, in terms of sectors?
There's other things that we can play, but it is pretty niche in terms of, we still think financials are a pretty good place to be. Not necessarily so much in the US. We still think in Europe there's places to play. We are still holding on to, the hedges in terms of energy for all the reasons that we've just talked about. That uneasy equilibrium means you could get a spike in things going forward. And, we're kind of holding on to our defense plays as well. Unfortunately, given the world that we live in, you're going to have a lot of parts of the world that are really going to have to replenish their stocks and, prepare for a world there. Potentially we could see a few more of these conflicts start to happen. So, we are taking in our bets, we are, putting in our hedges, but, still riding the upward trend in markets that we've seen, since the ceasefire was announced.
Does this moment, you'll hear a lot of discussion about this moment being a new catalyst maybe for investing in alternative energy? A lot of countries have already gone ahead and invested in that, but perhaps taking that up a notch and to get there faster in terms of other forms of energy, so that oil exposure in future years is not as makes them not less vulnerable. Does that make an interesting investment for you yet?
I think it's a story we've been playing for a while, but I think rather than necessarily, because this is no longer an environmental story. This is about economic security. And it's not, I think the issue is, yes, you want to diversify away from other countries, being in this space, but you also want to diversify the sources that you have. So, for some it's solar. A lot of countries have been rolling out nuclear as a source as well. Here in Europe, wind continues to be a pretty big source of energy. So that diversification is definitely going to continue. But again, it will very much vary in different parts of the world. Solar is, for a lot of the emerging market countries, global south, that is the way to go. And it's actually, relatively small part of China's exports, but it's certainly going to help keep those export numbers up, given that most people will be saying, yeah, we kind of need what you have, China.
Right. And I mean, the Middle East has been investing in that for a long time. They have a lot of sun. but in any case, if they can't get oil out in the way that they would like to in terms of export, you just wonder if there's transitions there as well are accelerated.
Absolutely. I think that, that is a trend that was there. This will have done nothing to put people off from continuing down that path.
In terms of the bond story and the way that ultimately you make allocations across things, what do you do with the bond story at this point? It hasn't cracked, hasn't had an awful time, but the correlations are hard to deny. What do you tell investors?
Yeah, this is a difficult one, right? Because the diversification that you wanted just hasn't been there. The correlations have been pretty high, and I think this plays into sort of our longer term theme about what is it that the bonds can provide from here going forward, and really big picture theme is if you look at the trends in especially the developed part of the world, with deficits where they are, the kind of payouts that people are going to have to make on the back of aging societies, etc. It's not looking particularly good for yields in particular. And if you take the view that certainly I have, that we are probably in a sort of more inflationary world going forward, if nothing else, because people are going to have to bring manufacturing closer to home. Things aren't going to be as efficient going forward. That's all inflationary. So, where we can, we are, suggesting to investors a little bit of diversification into commodities is probably a good place to be, given that they tend to be assets that do well when inflation is a little bit higher. And again, it's been interesting so far this year, right? It was working really well, didn't do quite as well as we expected, in the early days of the conflict, but I think we're seeing a return to that going forward. So, some commodity exposure is good. Within fixed income, you probably want to be in linkers a little bit more than possible. And again, within fixed income, you probably want to be, on the credit side of companies that probably benefit from the environment that we've just laid out.
Can you break down the allocation that you're managing at this point, or most recently that you're allowed to share with us?
Yeah, so we started off the year, reasonably positive on equities. So we were about, +5% on equities. We have been taking that down throughout. So we're still just about holding on to our positive equity view. It's about +1. But, I think going forward from here, if we don't see a resolution in terms of number of ships going through, we probably want to be neutral and just sort of take it month by month, because I do think that markets are perhaps underestimating at this moment the impact of supply being so low from a very important part of the world.
Okay, so that's the equity side of it, and then in terms of you mentioned commodities, but also bonds. Where do you sort of sit in terms of allocation?
Yeah, so credit for us is a little bit more problematic. I mean, spreads are very tight and continue to be that way. We still think there's more resilience in the high yield part of markets. And on the govy side of things, you really do have to be quite selective in terms of where you are. And we like index linkers. That for us is probably a part of the fixed income segment that continues to benefit.
When we came out of COVID, there were a lot of discussions about the types of modeling, for instance, that that had caused economic models in terms of supply side shocks and then demand side shocks, and we had a slightly out of sync level of the correct models to model what was going on. Is there something similar going on right now? I'm just going to ask you a little bit about your process and AI and how it helps you ultimately with perhaps modeling and usefulness within your job. Are you using that more? Does it help?
Am I using it more? Yes, we are. So certainly, that has been very useful. Is it a productivity boost? Yes, potentially it is. It does make modeling a lot easier, but I don't think it's the be all and end all that the people think it is so far. And this kind of goes back to the point that we were making earlier that in order for many parts of the Western world in particular, you're going to need that productivity boost from AI to really start to come through. And I think it'll probably be a lot slower than most people anticipate. And it's interesting because if you look at all the surveys, it's mostly emerging markets and people within that tend to be more enthusiastic about AI take up. So, again, it's fascinating as you look at China, look at India, other countries. People are a lot more excited about what AI will be able to do there than perhaps in this part of the world, which makes me think that perhaps that productivity boost that we're expecting might come in other parts of the world and not in in places where you thought it might have the most impact.
And that ties into part of your investment thesis based on that, or is that just sentiment at this point?
I think it's just sentiment at this point. It's not something that we are looking at. But I mean, I think clearly AI is here to stay. I think we are still going to see the implications of how this actually works out. But certainly if you look at sort of how many people are using it more, that's pretty much baked in now. I think most people you talk to in our organization are pretty much using it every day, to some extent to help make things a little bit better. It means certainly my analysts are coming up with answers to all my questions a little bit quicker, which is no bad thing. But as with everything, asking the right questions is pretty important. So there's still, thankfully, still some something left in our jobs. So that's good.
It's great to hear the global story from your perspective. You're in London. You're certainly meeting with investors around the world and considering their thoughts. I'm just wondering what you might like to leave investors with. I have a question about Canada and how it fits into the global story, if it does at all. But what would you say global investors are interested in right now? You're sort of sharing this with Canadian investors right now.
I mean, I think clearly we need to know how everything works out in this in this environment that we find ourselves. Certainly, it wasn't really on the cards, January 2, when we started off this year. But, I do think that this is actually quite important. I do think it affects most parts of the world, albeit at different levels. But finding a solution to this is going to be quite important. This is probably potentially one of the biggest shocks we've had to the economy since the 1970s. And then, we've lived through COVID. We still just about remember that. The good news about COVID was that you had, a lot of governments that were prepared to respond and provide support. That is probably not going to be as widespread as we thought. So it is something that does affect all of us. And, in that, perhaps there is a bit more hope because, you can see people getting together and say, right, we do have to do something about this before it becomes a bigger problem. So not completely, doom and gloom at the moment, but, certainly being cautious is quite important.
Yeah, and there might be some great innovations that come out of crises, as there always are.
Absolutely.
Ayesha Akbar joining us from London. Thank you very much for your time. We wish you very well. Have a great weekend.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.